Ever feel like you're drinking from a fire hose when you're trying to learn something new? There's so much information out there, but who has the time to really dig deep?
Right. It can be overwhelming.
Exactly. And that's what we're all about here. We take these complex topics, these dense research papers, and we break them down piece by piece so you can actually understand what's going on.
So you can walk away feeling like you've really learned something.
Absolutely. So today we're diving into a paper with a pretty technical title. It's called Achilles Neural Network to predict the gold V's US dollar integration with trading bot for automatic trading.
Catchy, right.
Yeah, well, you know academics, but don't let the title scare you off. The core idea here is using AI, specifically a neural network, to predict how the price of gold is going to move against the US dollar.
And then they took it a step further. They didn't just stop at predictions.
Right. They actually built a trading bot, a piece of software that uses those predictions to make buy and sell decisions automatically.
And get this, they even figured out a way to analyze financial news, to see how the overall sentiment, like whether people are feeling positive or negative about the market, might impact gold prices.
Okay, so they've got this AI making predictions, a bot doing the trading, and some fancy sentiment analysis going on in the background. What was the big takeaway? What really jumped out at you from this research?
Honestly, the most striking finding was that this whole system, this fully automated AI trader, actually made a profit.
Wait, really? It made money?
Yeah, they tested it for a month and it came out ahead. Which, let's be honest, in the world of finance, that's pretty impressive. Because, let's face it, predicting the market, well, it's not exactly easy, is it?
No, it's not. I mean, whether we're talking about Bitcoin going to the moon or the Australian dollar taking a dip against the USD or even trying to figure out what Amazon stock is going to do tomorrow, it often feels like you're just throwing darts blindfolded.
It does, doesn't it? And that's where machine learning comes in. The idea is that these algorithms can crunch through mountains of data, spot these hidden patterns, and maybe, just maybe, give us a little edge.
But I feel like we've all heard stories about these super sophisticated AI models that promise to beat the market, and then when you actually put them to the test, they fall flat.
Oh, absolutely. That happens all the time. Complexity doesn't always equal success, especially in the real world of trading. And the researchers in this paper, they were very aware of that.
So what were they trying to show with this study then? What was their main argument?
They wanted to demonstrate that it's possible to use machine learning to not just predict the market, but to actually do something with those predictions.
To actually make money.
Exactly, to bridge the gap between theory and practice, to build a system that can analyze the market, make predictions, and then automatically act on those predictions in a way that potentially leads to profit.
Okay, I'm starting to see where they're going with this. But one thing I'm curious about is their choice of focusing on gold versus the US dollar. Why not something else? Why not stocks or, the hot new cryptocurrency everyone's talking about?
Well, and this is what I found really interesting. They specifically chose gold versus USD because they thought it might be more predictable than other assets.
More predictable. Gold seems pretty volatile to me. It jumps all over the place based on what's happening in the world.
It does, but think about the nature of gold. It's a physical commodity, right? There's a limited supply of it on Earth. And we have centuries of historical data on gold prices.
So we're saying because it's limited and we have all this data, it might be easier to spot patterns.
Exactly. It might be easier for a machine learning model to pick up on those recurring trends, those relationships between different factors that drive the price up or down. And they contrasted this with things like Bitcoin, where the supply isn't fixed, or individual stocks, which can be swayed by all sorts of company-specific news.
Right. So you have all these external factors that can really throw things off, like one tweet from Elon Musk and suddenly Dogecoin is through the roof.
Precisely. It's much harder to build a reliable predictive model for something like that. And they also mentioned that existing stock prediction models, things like ARIMA and Profit, are often focused on predicting just a single stock and usually just one day at a time.
Which makes sense. You're trying to predict what's going to happen to, say, Apple stock tomorrow. But this research is different.
Oh, absolutely. This is all about minute-by-minute predictions for a commodity pair, gold versus USD.
So it's much more granular, much more high frequency. And these predictions are what's feeding directly into their trading bot.
Okay, let's talk about their prediction engine, the so-called Achilles. It's an LSTM neural network, right?
It is.
Now, I'm going to be honest, I'm not a computer scientist. Can you explain what an LSTM is in plain English? Sure, so imagine a regular neural network. It's like a network of interconnected nodes and information flows through it. And LSTM, which stands for long short-term memory, is a type of neural network that's really good at understanding sequences of data.
Sequences, like what happened first, what happened second, and so on.
Exactly. It's like it has a memory. It can remember patterns from further back in time, which is really important when you're analyzing something like financial data, where what happened yesterday or even last week can impact what happens today.
So it's not just looking at the last few data points, it's taking a much longer view.
Exactly. And in this case, they trained Achilles on minute-by-minute data. They fed it the opening price of gold, the high, the low, the closing price for each minute. They also included the trading volume.
So how much gold was actually being bought and sold?
Yep. And on top of all that, they added in two common technical indicators, the RSI and the EMA.
Okay, I'm going to need a little help with those. RSI and EMA, what are those all about?
So RSI stands for Relative Strength Index. It's basically a way to measure momentum. Is the price moving up strongly? Is it moving down strongly? Or is it kind of flatlining? It helps you see if an asset is overbought or oversold.
Okay, so it's kind of like a speedometer for the price, showing you how fast it's moving in one direction or the other.
That's a good way to think about it.
Yeah.
And then you've got the EMA, which is the exponential moving average. This is another way to smooth out price data over time. It gives more weight to recent price changes, so it's more responsive to what's happening right now.
Okay, I see. So Achilles is being bombarded with all this information, minute by minute, price, volume, these indicators. But how do they organize all this data to make sure the model could actually learn from it?
They used what's called a sliding window approach. Imagine you're looking at the last 2 hours of data, so 120 minutes. You use that data to predict what the price will be in the next minute. Then you slide that window forward by 1 minute, and you use that new 2-hour chunk to predict the next minute, and so on. It's like the model is constantly learning and adapting based on the most recent information.
Always looking at the latest snapshot of the market. I like it. So Achilles is getting all this data, but what about the model itself? Was it super complex? Did it have a million layers and a gazillion parameters?
You know, that's what surprised me. They actually kept it pretty simple. It only had 3 layers. An input layer, a hidden layer, and an output layer. And it had a relatively small number of parameters, something like 9,500.
Really? I would have thought you'd need a much more complex model to make sense of all this data.
It's counterintuitive, isn't it? But sometimes simpler is better. It can be easier to train, it can run faster, and it can still be very effective, especially when you're dealing with commodity markets like gold.
And they even tested it out on Ethereum,
Right.
which is notoriously volatile.
They did. They used ETH USD, Ethereum versus the US dollar, as kind of a proving ground for the model. And it did pretty well, even with all those wild price swings.
Interesting. And when Achilles was making its predictions for gold, what did that output look like?
They actually included some tables in the paper showing this. You could see a series of timestamps minute by minute, and next to each timestamp, you'd see the predicted price of gold for that minute.
So a constant stream of predictions. Okay, but predicting 1 minute ahead is one thing. How did they use this to predict over longer periods, like the entire month of their test? Did they just let the model run wild?
No, they used a clever technique called stacked prediction. So they predict the next minute, right? Then they take that prediction, add it to their data, and use that to predict the minute after that.
So each prediction becomes part of the input for the next prediction.
Exactly. It's like building a chain of forecasts. And that's how they extended their predictions out further into the future. Okay, so we've got Achilles cranking out price predictions, but they also mention sentiment analysis, right? Using AI to analyze financial news.
Yeah, that was the part that really caught my attention. How did that all work?
So they brought in another model called FinBERT. FinBERT is specifically designed to understand the sentiment, the emotions being expressed in financial news.
So, like, is the news positive, negative, or neutral about the market?
Exactly. They pulled news from 3 different sources: Benzinga.com, investing.com, and FT.com.
Why those specific sources?
Well, they're known for being pretty unbiased, and they publish news in real time. So every 15 minutes, their system would grab the latest headlines and articles from those websites, feed them to FinBERT, and then FinBERT would spit out 2 things: its assessment of whether the market was likely to go up or down, and the overall sentiment of the news.
So they're trying to capture the mood of the market, so to speak.
Precisely. But how do you turn something as fuzzy as mood into something a trading bot can use?
Right, because the bot needs hard numbers.
Exactly. So they assign numerical values to the sentiment. Positive sentiment was a +1, negative was a -1, and neutral was 0. Then they averaged the sentiment across the three news sources to get a kind of overall sentiment score for that 15-minute window.
Okay, I'm following so far. We've got Achilles making price predictions every minute, and FinBERT giving us a sentiment score every 15 minutes. How do those two pieces come together in the trading bot?
This is where the magic happens. The bot actually has two loops running. There's an inner loop that runs every 15 minutes. This loop grabs the latest news, does the sentiment analysis with FinBERT, and gets that probability score.
Okay.
And then there's an outer loop that runs every minute. This is the loop that actually makes the trading decisions.
So it's taking in both the price predictions from Achilles and the latest sentiment analysis from FinBERT.
Exactly. It's combining those two streams of information to decide whether to buy gold, to sell gold, or to do nothing. And it's important to note that they tested all of this using a paper trading account.
Meaning they weren't actually risking real money.
Right. It was all simulated, no real trading fees or commissions. It was a way to test the system in a safe environment.
Smart move. So walk me through the logic. How did the sentiment score actually influence the bot's decisions?
If FinBERT was feeling positive, meaning the sentiment score was high and the probability of the market going up was above a certain threshold, which they set at 0.87, the bot would consider buying gold.
Okay, so it's seeing positive news. It thinks the market is likely to go up, so it wants to buy low and hopefully sell high later.
Exactly. And on the flip side, if FinBERT detected negative sentiment and the probability of a downward move was below 0.5, then the bot would think about selling.
So it's trying to get ahead of the curve, sell before the price drops too much.
Right. But if the sentiment was neutral or the probabilities weren't strong enough, the bot would just hold off. It wouldn't make any trades.
So it's not just blindly trading all the time. It's waiting for the right opportunities.
Precisely. And once it had a position open, meaning it had either bought or sold gold, it would use the price predictions from Achilles to decide when to close that position.
So it's not just about entering a trade. It's also about knowing when to exit.
Absolutely. The bot would look at a 20-minute window of predictions, 10 minutes into the past and 10 minutes into the future.
Okay.
If it had bought gold, it would aim to sell when the actual price hit the highest predicted price within that window, but only if the price wasn't simultaneously at the lowest predicted price. It was trying to avoid selling too early or too late.
So it's like it's riding the wave, trying to catch the peak.
Exactly. And the logic for selling was similar. It would aim to buy back its position when the price at the lowest predicted point, but only if it wasn't also the highest predicted point. And on top of that, the bot was programmed to prioritize closing the two most profitable open positions.
So always trying to lock in those gains.
Right.
Okay, enough about the theory. Let's talk results. After running this whole system for a month, did it actually work?
Okay, drum roll, please. Over that 1-month test period, which ran from September 1st to September 30th, 2024, excluding weekends, the bot made a total profit of $1,623.52.
Wow, that's more than a 150% return. Not bad for a month's work.
Not bad at all. And remember, they started with a simulated account of $1,000 and were using a risk level of 0.3, meaning they were willing to risk up to 30% of their capital on each trade.
So they weren't being overly cautious. They were letting the bot take some risks. Were there any particular periods during that month where they saw big wins or big losses?
The first couple of weeks were relatively quiet with smaller gains. Then things really picked up between September 17th and 19th. They saw a big jump in profits there. And then from September 20th to 23rd, they had another good run.
So some burst of activity followed by calmer periods.
Exactly. And there was one day, September 25th, where they actually lost money. On all the other trading days, the bot chose not to trade at all.
So it wasn't just constantly in the market, it was being selective.
And they specifically mentioned that the bot was using a shorting strategy, which basically means it was trying to buy low and sell high. And it was often patient, holding on to positions for days or even weeks until it saw the price move in a favorable direction.
Interesting. So even though it's an AI, it's not just reacting impulsively, it's waiting for the right moment. But even with all that, they still had that one day with a significant loss.
They did. It lost $119.57 on September 25th. Which just goes to show that even with AI, there's always risk involved. No system is perfect. And they were very upfront about that in the paper. They pointed out that most people who try to trade actually lose money. It's a tough game.
It is. And they also compared their system to other machine learning models, right?
They did. They looked at a bunch of different metrics, things like the testing loss, the mean absolute error, and the mean absolute percentage error. Basically, they're measuring how accurate the predictions were.
And how did Achilles stack up?
It actually outperformed the other models. Its predictions were, on average, closer to the actual prices.
Okay, so we've covered a lot of ground here. What are the key takeaways? If I'm a listener who wants to understand the big picture, what should I walk away with?
Well, I think the main takeaway is that even relatively simple AI models, like this Achilles system, can be surprisingly good at predicting the short-term movements of commodities like gold. And when you combine those predictions with a smart trading bot that also takes sentiment into account, you can potentially generate some impressive returns.
But it's important to remember that this was all done in a simulated environment.
Right, this wasn't real money. And they were very clear that their findings don't guarantee you'll make money if you try this at home. Real world trading is messy, there are fees, there's slippage, there's a whole lot of risk.
And they only tested this on gold versus the US dollar. We don't know if it would work for other assets.
Exactly. More research is needed. But still, the fact that they were able to achieve these results is pretty remarkable. It definitely makes you think about the future of AI in trading.
It does. Imagine a world where AI is helping us make smarter investment decisions, or even managing our portfolios for us. It's a fascinating possibility.
And a little bit scary too, right? I mean, do we really want to hand over our financial futures to algorithms?
That's the big question, isn't it? Where's the balance between human judgment and AI-driven automation? It's something to ponder as we move forward into this brave new world of finance.
Definitely. And if this whole conversation has piqued your interest, I encourage you to dig a little deeper. Read up on LSTM networks, learn about sentiment analysis, or maybe even do some research on the gold market.
Yeah, the more you understand these concepts, the better prepared you'll be to navigate the increasingly complex world of finance.
Absolutely. Knowledge is power, right?
Always. And on that note, we'll wrap things up here. Thanks for joining us for another deep dive. We'll see you next time. See ya.